Video at what we call the economic efficiencies. Now, there's basically allocative, productive, technical or X inefficiency, and dynamic efficiency. Those are the best ones to use, and it's really important that you're able to look at markets and look at the different types of firms and see whether or not they have these efficiencies. Okay, so the first one, one of the most important ones, possibly together with productive, but this is a key one, is this concept of allocative efficiency. Now, you are talking there about the allocation of the scarce factors of production. That's the key to it. It's about the fact that the fundamental economic problem is that you have scarce factors, and so if you use them up for producing, green cars, then you can't use the factors of production to produce something else. Okay, so therefore you're looking at whether you're allocating those scarce factors to the industries where you are getting the most benefit from them, and that's the concept between allocative efficiency. In other words, it's the allocation of the scarce factors, and in a market it's where demand equals supply, as we'll see in a minute, because that's where the demand is a reflection of your marginal benefit, supply is a reflection of your marginal cost, and if you're in equilibrium, marginal benefit equals marginal cost, then you can argue that you have allocated the factors in the correct way. And all of last year in microeconomics, you've been looking at how different demand and supply changes move factors, hopefully in market systems, move the factors around the economy. When it comes to the firms, you're looking at the idea that the price that is paid, which is the average revenue, is some reflection of that marginal benefit. So again, the underlying assumption will be that you are rational consumers, and that the price that you're willing and able to pay reflects the marginal benefit that you know you're going to get from the good, and that's going to equal the marginal cost of using up the scarce factors of production. Always worth putting that phrase in. It also occurs at some point on the PPF. So when you draw your PPF, there is one point on the PPF which is allocatively efficient. Okay, productive efficiency is some output level where you've achieved all the economies of scale, you've got onto the lowest point of your ATC curve, and your productivity is therefore maximized. So remember the link that you've already discovered, hopefully, between the level of productivity, average product or marginal product, but certainly average product, and the lowest point of the ATC. So the link is between average product and average variable cost there. It's also on your PPF, it's at any point on the PPF you are productively efficient. In other words, you can't produce more, and one of the assumptions of your PPF is that every factor of production is working, and secondly, they're working at their maximum productivity. So if that's the case, any point on the PPF is productively efficient. Okay, technical and X inefficiency is where firms are producing on the average total cost. In other words, at some level of output, whatever level of output it is, you are on the ATC curve, rather than producing above it, and I'll show you what we mean by that in a minute. So the difference between those two: productively efficient, you have reached the level of output where you are on the lowest point of the ATC. Technical or X inefficiency, at any level of output you are producing, you have moved your, basically you've employed your labour and capital to the right quantities so that you are producing at the lowest possible cost for that particular level of output. Okay, so there's a slight difference between those two. And dynamic is the basically getting all these efficiencies working in the long run and having supernormal profit, enabling you to innovate and invest in the economy or in the firm, so that you are always bringing in the latest innovations. So let's have a look at all of them through diagrams. As I say, allocative efficiency, year one, price equals marginal benefit equals marginal cost. Our standard supply and demand curve. Supply is a reflection of the marginal private cost, demand a reflection of your marginal private benefits. Therefore you have a lovely consumer surplus here, producer surplus here, hopefully you know what those are, and in equilibrium, when you're at equilibrium here, you have basically maximized those two surpluses, and so it is the optimal allocation of those scarce factors. In other words, if we had stopped before that point, let's say here, we'd be asking ourselves, and this is always the question to ask with this allocative efficiency, should the economy have produced more? And so the answer is, well, if at this point here, let's say we stop here, the marginal benefit is up here, the marginal cost of producing those goods in terms of using up the scarce factors is down here, so you would have gained some welfare, okay, by producing more. So this is the point where, when the market stops there, you have got allocatively efficient. It's where demand equals supply. That is assuming no market failure, no externalities or something like that, okay? And you should stop there, and you shouldn't produce more because the extra cost exceeds the extra benefit, okay? So the consumer and the producer surpluses are maximized. The welfare of the economy is maximized too. So you've allocated the correct number of factors of production into this market here, because you've gone on and you've maximized the surpluses, and you have actually managed to get to a point where any extra benefit, or going on from there, should I produce one more, well, the extra cost of using up the scarce factors exceeds the extra benefit we would get from it, and so therefore the answer is no, we shouldn't. So allocative efficiency, price equals marginal benefit equals marginal cost initially, year one. Okay, gets a bit more complicated sometimes in year two. This obviously is your perfectly competitive industry, this is your perfectly competitive firm, and we see that in the long run equilibrium we are allocative efficient because the price, which always equals the average revenue under the theory of the firm, equals the marginal cost, okay, here, because it equals the marginal revenue. And profit maximizing firms set MR equal to MC, so they produce at this point here, and that also is a point where the price, which is AR, equals MC. So as long as you've got a perfectly elastic demand curve, then you are always going to be allocative efficient, because you cannot, as I say, you cannot make supernormal profit in that industry. With a monopoly, it's different, and you need to watch the monopoly competition video to see the full explanation of the differences. But in a monopoly, the average revenue is higher always than the average cost, the marginal revenue. So therefore, at the point of profit maximizing, where you set your MR equal to your MC, the price is bigger than the marginal revenue, which is equal to the marginal cost. So price exceeds marginal cost, and the argument is that, again, the question is, should we produce more? Yes, we should, because the extra benefit is up here, the extra cost is there, so all of this output to this point here would gain you extra benefit exceeding extra cost, and it would have increased your welfare. So therefore you have under consumed and produced in this market, and you should have gone on to MC equal AR, AR always equals price in the theory of the firm. So this point here would be your allocative efficient point, and you stopped below it, and so we have a welfare loss for a monopoly. Okay, so hopefully that's helpful in terms of allocative efficiency, but the key is that you link it to the allocation of the scarce factors of production. Productive efficiency, as I say, is linked to the level of output, and so it occurs when the output level is on the lowest point of its ATC. So for example, in a monopoly, the MC goes through the lowest point of the ATC. This level here would be productive efficiency. So in a monopoly, you're not likely to get to that point because you'd stop, let's say here, before it, And the argument is that nothing is driving that monopoly to. It might by chance, we might have put that ATC there, we might have put it through that lowest point there, okay, but that's only by chance, so nothing is driving it to that point. Whereas in competition, perfect competition, of course, we are at the lowest point, and that's because you've got a perfectly elastic demand curve, so AR equals ATC, no supernormal profits in the long run. And because that also happens to go through, the MC goes through the lowest point of the ATC, that also is the point of profit maximizing, MR equals MC. So you are always productively efficient in the long run in competition. And trying to remember and explain that what we mean by productively, why lowest ATC, you're talking about costs, and here you're talking about production. Well, it's because at the lowest point of the ATC, that was at the highest point of your average product. So there was a relationship, if you remember, between the highest point of your average product curve being at the lowest point of your average variable cost curve. So the relationship is there between the production, the productivity, and the lowest cost. So when you're at your maximum productivity, you're at your lowest average costs. So that's where that concept comes from. Okay. X inefficiency, very difficult diagram, pretty awful, and really the only reason that maybe we were asked to do this. If you remember that the long run average cost curve is some envelope curve which is linked to the short run average cost curves, and what we mean by that is this, that you have a series here, they're in different colors, of short run average cost curves. So this blue one here is a short run average total cost curve when I have 1 unit of capital. That's one machine, let's say. And then I have another one here, this red one here, 2 units of capital, and this one has 3 units of capital, and this one has 4 units of capital. So the argument is you have in the short run the ability to add more and more capital to your firm. In the long run you're able to do that, but in the short run you're stuck with either 1 or 2 or 3 units of capital. So you have to work your way through the diagram and say, well, what would happen with the firm if it starts producing more and more and more, and so you increase the quantity along this axis here. So the argument is that we would be using up 1 unit of capital, and to add more output we are adding more of the variable factor, which is called labour. And then at this point 1 here, quantity 1, let's say we want to produce more to go up to quantity 2. There's 2 options. We can either buy a second machine in the long run and move on to this short run average cost curve with 2 units of machines, or we could just add more and more variable factor and we move up the short run with only 1 unit of capital. So this here would be X inefficient because you are only employing 1 unit of capital where you could have brought a second unit in the long run and got down to being on point say 2A. I hope that makes sense to you. So this is one short run curve with a 1 unit of capital, second, this one here, 2 units of capital, and so it's a question of whether or not you are maneuvering and adding in and getting the right allocation of your capital and your labour, if you like, to the firm. So let's say we move on to point Q3. We're now having another decision. Shall we stay with 2 units of capital? Because in the long run we could introduce another machine and we could move on to another short run average cost curve. So the argument is that if you decide to change to the add more and more capital, then you are able to go here to here to here to here. So the long run average total cost curve is the lowest possible cost at any quantity that we are producing, because you've got the right number of machines and labour in your firm, and that would be called X efficiency. Whereas if you hadn't got that right number, you would be operating at any of these points, you could be operating, but you'd be operating above the long run average cost. So in other words, at any quantity of output here, you can be X inefficient if you are producing this, but you haven't maneuvered your capital and labour in the right way, so that you get your lowest possible cost. In other words, you could be here, that would be X efficient, that's X inefficiency if you haven't introduced the new machines that you could use. So all of these points are X inefficient, whereas this point here is the first time we reach this lowest point of the ATC curve, and that has a special term called the minimum efficient scale. So this is the first time you reach the average lowest point of the average total cost. So you are basically productively efficient here, but with this level of quantity, if you are also X efficient, you are producing at the lowest possible average cost given that level of output. Okay, so as I say, productive efficiency is have you reached that scale here. X efficiency is whatever scale, whatever size of the business, whatever quantity, are you mixing up your capital and labour so that you're producing at the very lowest average cost. That's the big difference. And then, as I say, these are X efficient points. Then you have the final one, which is dynamic efficiency, and that really is quite important in an economy, and not just for individual firms or industries, it's also for economies, and it refers to a situation where the firms in the market are introducing the latest machinery, the latest technology, so they are always producing at the lowest possible cost. They bring in innovation, which is really where we get sustainable economic growth from. Okay, so the use of innovation, the use of new technology, the use of the latest machinery is going to bring us sustainable economic growth. So you can see it's a much wider concept really. And the argument is that if firms are making supernormal profits in the short and the long run, they can use this profit to make the investments. So the best phrase to use is that they have the incentive to do so. They have the incentive to bring in new machines and innovate. So they have the ability and they have the incentive. So they're making supernormal profit, that gives them the ability, and they will keep supernormal profit if they are monopoly or they have some form of barrier to entry. So they have the ability to and the incentive to introduce new investments, and so therefore the industry will be dynamically efficient, and it moves on to a lot of ideas of development and economic growth, etc., being sustainable if your economy is dynamically efficient, and you can talk about ideas called creative destruction and those sorts of things. So worth having a look at that as well if you want to go a bit deeper in this. So as I say, allocative efficiency, productive efficiency, really important to know. Technical and X inefficiency, again, make sure you understand what that means. And then last one is dynamically efficient, which really brings in the idea of profitability, and the ability to make supernormal profits isn't necessarily such a bad thing, because the firms can be dynamically efficient. So you'd be arguing, for example, with a monopoly, that some consumers would prefer to pay a higher price, give the firm some supernormal profit if the firms are then innovating and bringing them new products and more up-to-date and more efficient products as well. So it's a trade-off between paying a bit of a higher price, giving them the profit, and then getting more choice and better styled products, etc. So hopefully that gives you a good overview of what we mean by the efficiencies.